Welcome to the 2021 Westwood Economic Outlook. We are pleased to have you join us, and we hope very shortly to return to in-person events. But we found that this format does work well. Several of you all have submitted questions via email already. If you have not had a chance yet to submit your questions, there is a chat, and you've joined us digitally, there is a chat function that you're able to use if you want to ask a question of Adrian during his presentation. We will compile those questions throughout the evening, and Leah Bennett, the president of Westwood Houston, will work with Adrian to get those questions answered for you towards the end of the presentation. Tonight, we are fortunate to have Adrian Helfert join us to discuss his perspective on the markets. And good news for everyone out there, he has been pretty positive on the markets of late, and I'm definitely interested to see what he thinks the rest of the year holds for the equity markets and credit markets. As a reminder, Adrian joined us in early 2019 to lead our multi-asset strategies. He is the Chief Investment Officer of Multi-Asset Strategies for Westwood. He has been instrumental in the development of several of our new strategies, including credit opportunities, high alpha, and some of our newest capabilities around systematic equities of small cap and large cap growth. Adrian, we're thrilled to have you join us tonight and to give us your perspective of the coming year, and I'll turn it over to you.
Great, thanks, Porter. Thank you all for taking the time to join this evening. So, as we're talking about 2021 and our outlook, of course, we have come through what has been an extraordinary 2020. And I changed the tune a bit. I originally had a title on this that was a little more negative of, gosh, we're so happy to be in 2021 after a momentous 2020. But in many ways, it's been a blessing in disguise. It has forced much of the technological change. It's moved into different areas that previously we didn't actually have going forward. So the train keeps rolling. The market is continuing to move. The next is thinking about where those bins are going to be. I always like to look back on this next page of kind of like having a diary of what were we looking at it before? What were the catalysts that were driving the market environment before? There's always something. And if you ask a marketeer, pundit like myself of, is there any downside risk? There's no day you're going to ask me, I'm going to say no. There's always something. 2019, it was the China trade war, where you see something hit the news cycle and it would be the market down 2% the next day. It was still a driver of volatility. The US recession was, funnily enough, something that was on the minds of people as the US interest rate curve was foretelling the possibility of a forthcoming recession. And when the US interest rate curve, the difference between the 10-year yield and the 2-year yield goes to zero, oftentimes it's figured as a prognosticator for a forthcoming recession. The funny thing is that it hit zero just before the COVID crisis really hit. So in some ways, it predicted what happened on the COVID crisis. I do say in jest, but that is off the palette now. We're not considering a recession. We've come through a cycle. We have provided loads of stimulus to the environment. So the question is not growth, it's how much growth. 2020, last year, of course, we were looking at the US elections, the volatility around policy uncertainty, which path we're going to be going down. Trade war was still a theme that was driving the market environment. 2021, we've been through the election, so now it's the regulatory landscape. We can start to see what policy is going to look like. Hopefully CFOs can start to plan for better or for worse on what their tax implications are going to be. A default cycle for those companies that are kind of just limping along right now, but may not be able to make it. That's on us as individual selectors to look at those companies and say, this is a company that can take market share in that environment, or there will be other companies that simply cannot make it for very long. We do see that as a possibility. New employment level, we'll get employment level numbers again this week, and we're still riding it, even though it's come down strongly, the unemployment level in a good way. We're still at elevated unemployment. And we're going to be talking about, among other things, modern monetary theory, or otherwise known as how in the world do we pay our elevated debt load as the United States? Um, Many of us are looking at this and, with our economist hat on as the prospect of we may simply have to finance our debts, i.e. print money, because the debt load becomes too strong to simply grow or tax our way out of it. Those two things don't usually go well in tandem. So that's going to be an emerging theme. If you've heard me speak before, I often talk about a vicious or a virtuous cycle. I tend to think it's a simple way of looking at the economic cycle that we go through. And I think generally that the Fed and the Treasury, or the fiscal side and the monetary policy side, look at it similarly. It's confidence. I feel good. I can walk across the street and get a job. My wages are going to come in. My bonus is going to be good. So if that happens, I'm going to go buy that new trampoline in the backyard, discretionary spending, or the new red car. The more I do that, of course, companies say, well, we're going to spend as well. We're going to create more machinery to create more trampolines or more pieces for the new red car. And as they do that, they have to hire. They have to hire to manage the machines and manage people to manage the machines. With a similar amount of demand and the same supply of jobs, then wages rise. And subsequently, I can walk across the street and get a job. My wages go up. So therein lies the cycle. And looking at it from that lens, then we can say, well, what's been happening on that cycle? Just to start, consumer sentiment has been one of the weaker areas that has not yet come back. Consumer sentiment is more often related to discretionary spending, of going out and spending for that trampoline and the red car, and it's remained muted. Now, granted, when you look at the chart on the upper left-hand side on this page, it's about long-term average, but it's certainly not to pre-COVID levels. If you look at consumer spending, non-discretionary spending is above pre-COVID levels. That's going out and buying the washing machine. That's updates that are required for your house. But discretionary spending is not yet back to pre-COVID levels. People are restraining their spending to some degree. Unemployment is coming down. It's come down faster than I ever expected. And I modeled this out I thought we wouldn't be at this level before 2024. But CFOs, CEOs, managers brought back their employees from furlough. They brought back their business online very, very quickly, which is a good thing for the environment. So maybe faster than the data will foretell. Capital expenditures have remained reasonably stable. We see them as increasing as well as businesses are adapting to the new environment. Out of this, and of course, wage growth is one of those metrics. Wage growth, funnily enough, has been rising faster than core CPI. So you can buy more milk with that same level of income than you could before, proverbially. That's a good thing. That means more possibility for savings. That means more possibility for consumption for the U.S. consumer. And recall, the U.S. consumer, that's 75% of our economy. So it's a large factor that goes into our models. Of course, we did a client survey. We wanted to highlight a couple of the areas that came out of it that were very interesting. And we used our internal folks as well. So we have a pretty good diaspora of individuals that goes across the dynamic there. Are you spending more or less today? Generally, it looks like most people are about the same. I kind of figured that we would get there. The skew is to less. And that's kind of a good thing. That means we're seeing restrained spending as people are still sheltered in place, maybe less so as of today with the Texas news, but people are spending a little less. That's the skew that we see in that. Consumer sentiment focus, let's just look at that for a second vis-a-vis the survey that we conducted. Consumer sentiment still is, of course, low, and we see this in several areas. We see it starting to come back a little bit. What's interesting, though, is I think this dynamic could be a little bit different, and we see that in our own survey. We asked, do you expect to increase spending, consumption once social distancing concerns lessen? This was not a presidential election. This was a landslide if it was. This was 65% of people expect they're going to be spending more once we actually come out of, once we reach herd immunity or once we come out of shelter in place. So that was a very good signal for, we're still restrained on the surveys on our outlooks. Looking forward, people are expecting that when things move forward, we're going to be spending what is 75% of the economy. A little focus on jobs. Jobs are a big question mark for the year. And that's what it was on the front page of. That's something we're going to be considering. It's usually one of the number one indicators for how well housing does, for how well spending does, how well the economy does. Thus, And we're at an elevated level of unemployment at around 6.3% today. We'll get an update on Friday when we get the new unemployment numbers. If you look at that chart on the left-hand side, that's one of those, gosh, wow kind of things. We're still on unemployment at a very, very low point, even considered to the 2007 unemployment recession. But we've come back so fast. Of course, many of these employees have been furloughed, and we count furloughed as unemployed. But we do expect as well, when you look to the right, there's some good aspects of this. Companies are looking at their structure and their cost structure and saying, maybe there's some operating leverage to be had here. Maybe we can look for ways to operate more efficiently. Businesses don't just sit still, they adapt. Maybe they can provide more productivity by doing something a little bit differently. So let's take 80% of our employees off furlough. Let's reindustrialize and see if we can make ourselves more productive. But I think we're going to see a little bit of that. As I say, we'll start to see the unemployment data going forward. I think it'll be less of an impact on housing than it has been in the past. We'll talk about that as well. On the capital expenditure side, we often look at what is the Duke CFO survey. So a survey of 500 large company CFOs in America to say, how are you feeling right now? Are you looking to deploy more capital? Are you going to buy more widgets? Are you going to update your machinery right now? Is the forward expectation such that you're either going to return capital, pay down your debt, or deploy more resources into operating leverage so you can capture a higher consumption rate? Interesting that some of their most pressing concerns right now, it's not looking at financial health of customers. That's down low. It's actually ability to hire. They're looking to hire folks. They're looking to see if they can increase their business capacity for what is an expected jump in consumer spending. And so you see it coming out of the surveys. I think, looking at it this way is one of the fastest ways we can get an indication of what the health of the economy is going to look like going forward. On the next slide, I think it's good to look at our home building environment. Of course, that's, a big course of the last recession that we had was the home price depreciation that we saw. Gosh, this time has been wholeheartedly different. It's been different for several reasons. Number one has been the low mortgage rates. Number two has been the supply of homes coming into this. There's a metric that says the months of supply given current purchase rates of homes, and we are at multi-generational lows of supply of homes. We have like 2 months of supply. So the home builders are ready to make hay as soon as they can buy the lumber and as soon as they can make the homes, which is one reason why lumber prices are up over 100% over the past year. So this is an extraordinary year for that. All of this comes into, on the lower left-hand side, you see house prices are rising. I look around my neighborhood, I use my Zillow account sitting on my couch at home, and there's nothing for sale. And when it comes for sale, the average sale time is around 10 days. So we're in an extraordinary environment for that. What that means for us, of course, is a wealth effect. And you can see that wealth effect. You can try and calculate it, as I have done on the lower right-hand side, looking at how much additional wealth effect might come in and impact consumption. 75% of our economy, and it is extraordinary. So there's a multiplier effect we get from housing, and housing is at a good place right now. Savings rates are high. Consumer balance sheets are at a better place than they were in the 2007 global financial crisis. So there's a positive story to tell there. Now valuations are elevated. I talk a lot about this is the market we're in. This is the economy. This is the economics. There's the second level thinking, which is pricing. How much of this is all priced in? Valuations are elevated right now. Looking at the price to earnings ratio on the S&P 500, it's over 30 times right now, which is very elevated. If I look at it as cyclically adjusted, which is an inflation adjusted, it's lower. It gets us back to other elevated rates, but it gives us room for movement. On the next slide, though, what's important is the low rate environment that we're in. The low U.S. Treasury interest rate environment gives capacity for an increased elevated price to earnings ratio. Simplistically, and so I have it on the slide here, but just simplistically explaining, the way we look at a discounted cash flow to derive what the appropriate price for a company is to take an interest rate and discount those future cash flows. $10 in the future is worth less than $10 today. Discount them by the interest rate plus a risk premium Well, when the interest rate is very low, those cash flows are worth more. The revenues haven't increased, the business model hasn't changed, but cash flows in the future become worth more, which makes the possibility for an elevated price to earnings ratio appear in the environment that we're in now versus one where in January 2010, the US Treasury rate was around 4.5%. So looking forward, another thing out of that is for the past 10 or 11 years, we have been through a real yield-seeking environment, what we call a carry trade kind of environment. As yields have gone increasingly lower, we're going to see more of that. We're going to see a push for yield, for better or worse, because it will push risk into areas that will inevitably be called bubbles and will burst. That's on us as asset managers to look for that. Right now, one area it's pushing into is the equity market. That's not a bubble. It will push into emerging market bonds. It will push into CMBS, commercial mortgage-backed securities, and other areas. But what's clear is that green line is the differential between the S&P 500 yield and a U.S. Treasury yield since 1990. And it's really attractive to hold the yield of the S&P 500 right now, relative. And that's by design by the U.S. Central Bank. They're looking for growth and they're pushing that. On the next slide, no surprise here. If I'd added to the survey, do you think higher deficit spending will at least lead to higher returns for the S&P 500? I'm pretty sure it would have been 100% yes. That's the near-term stimulus. And so just putting numbers to a page, yes, large deficit spending that we saw last year, and we're going to see this year, whether it's a $1.9 trillion package or negotiated significantly down, as I would expect, is still going to be significant deficit spending, providing stimulus to an economy that's in the midst of reopening. So there's an additional tailwind for the economy. Right now, interest rates, more near term, have been moving higher. And this is, I'm a daily guy. I've got my 4 screens up and I'm looking every single day. Well, the recent has been that interest rates, especially the 10-year US Treasury rate, has been moving higher and fast. And there's a lot of questions around that. Number one, is the 2-year interest rate moving higher? It is not. The US Central Bank is going to be holding interest rates low in the front end for a considerable amount of time, effectively using what's called the portfolio balance channel to push people into riskier product or push the expected growth rate up. And the 10-year nominal yield on a US Treasury is a proxy for US economic growth. Looking over the long term, that average yield runs about the average of nominal GDP growth. Well, we're looking for nominal GDP growth in excess of 6%. And a US Treasury yield, while it has risen fast, is still at around 1.4%. So it could go further. It is naturally in check to some degree by the reaction of equity markets, but we also think that it can go further and equity markets can absorb some of that higher discounting rate to their cash flows. On the next slide, on inflation expectations, that's become more topical lately. I was literally just before this, one of my colleagues and I pulled together the Google search trends for inflation on that lower left-hand side. And the recent spike is the increasing conversation that we have. It says we are right now, as of today, when I ran that Google search, we're at the highest level of discussion point around it. So people are Googling inflation. Does that mean they're concerned? Probably. When I look at the survey of the client results, the majority of us are slightly concerned around inflation. We're probably concerned around what that means if we're business owners and what that means for labor cost inflation and input cost inflation. For our asset prices, of course, inflation is a bit of a mixed bag. Real assets can help us appreciate, that's house prices, whereas intangibles may not do so well. Other real assets may not do so well. Equities generally perform well in an inflationary environment. That said, bonds do not. So we'll see how it goes. Right now, if the Fed were a voting bloc, they would have been in the not concerned at all 4% on our client survey results. As what they're saying and what we're saying here is they've said, we're going to let the economy run hot. We don't think inflation is prospectively coming in the near term. It's more important that we keep unemployment as low as possible. As a result of the crisis on this next slide, you see that leverage in corporates in companies has spiked. It spiked because last year companies came in droves and borrowed in debt. Company came in droves and they issued equity and IPO'd. It was amazing to see that after such a short, from March 9th until about March 23rd, we saw that amazing correction. And afterwards, companies came and said, oh my gosh, we need to bolster our balance sheet. We need to be prepared just in case we see a longer closure of financial markets. Now, the upshot of that is many of these companies have a better structured balance sheet. Their maturities are out farther. They're more prepared for a closure in financial markets. The downside is if we see slower, longer economic growth, we may end up with some zombie companies that are unable to service higher levels of debt. So something that we're watchful for as selectors is how companies have managed their balance sheet and how the growth is going to occur for them. That results in, thinking about default expectations. We look at this as allocating across capital. Of course, looking at default expectations, there's two things that have impacted us. Number one, as we see an optimistic growth environment that will help many of these corporates not only survive but prosper. But number two is the central bank drew a bright line under systematic risk during the crisis. They said, we're going to buy actively the bonds of these companies. So a lower default environment. I'll skip forward just a little bit on the COVID vaccine side. Can't go without mentioning some of the statistics there. On the COVID vaccine, of course, vaccines are being administered at a very good pace here in the United States. We're running third or fourth now in the world as far as percentages. And vaccines administered, I had this slide updated as of February 3rd, and we were discussing it earlier. February 3rd, it was around 35 million. Now we're up around 80 million. So it's increasing. We're getting vaccines out. The approval of the J&J vaccine was even better because that's one shot and you can store it at a higher temperature. So soon we're going to be at a place that we can prospectively look at maybe even herd immunity. Funnily enough, when you look at that lower chart, though, on mobility index, we haven't seen that. We haven't seen mobility or people out eating at restaurants just as they get vaccinated. It's remained muted. This is actually published by the Federal Reserve Bank of Dallas as well, and it takes into account the activity on various phones of how people are moving about. So maybe there's a bit of secular change that we need to think about. Certainly there is on how people act, but there's also going to be as we reach a certain point of herd immunity or people getting out there, I think we'll see a spike in this. I think people are going to be, as we'll see at the survey at the end, going to the movie theaters. They're going to be hopping on planes. They're going to be driving around and going to the restaurants. So we'll see some of that. Now, on our client survey results, it was interesting to see, to me, that about 13% expect not to receive the vaccine. They don't want to receive the vaccine. That's about on average. About 20% have received the vaccine. The remainder were kind of just sprinkled across. Nobody really knows. Everyone's looking for it. And as I said, we included our internal people as well. So, as far as the dynamics, we've got, I think, a broad representation of age groups represented. And it's kind of sprinkled across everywhere. So it's, we're looking right now at the potential for herd immunity come sometime around September or third quarter of this year. Bitcoin has been, I needed to throw a slide in Bitcoin because it's so topical now, and I'm interested in just evaluating it as well. What does it mean for transformational dynamics in the environment? Big question that we can actually attack is Bitcoin a store of value? Is Bitcoin like gold? Is Bitcoin like art on the wall, or productive real estate like farmland, which is also a store of value? And we can opine and we can think about it. I think there is some degree that it is. It has a finite amount of Bitcoin that can get created by nature of the blockchain that it is produced on. But what would need to happen, it still requires confidence for people to go out and say, well, I'm going to believe that store of value is something that I want to hold. Otherwise, I don't care if there's only a single, rookie Brett Favre card. It's not worth anything to me. I know they're worth a lot because my son is buying them, but it still takes confidence. And what else needs to happen? We need a change over from what is 4,000 years of history in gold to something completely anew. We're seeing a little bit of that, it appears today, but we need confidence. We need another another problem not to happen with Bitcoin. So that will keep going. I think there's a dynamic to be had here. We need volatility to reduce as well, so investors can feel more safe actually putting their safe haven money there. I don't think it'll replace fiat currency. It won't replace whether it's digital fiat currency, your credit card usage, or otherwise it's just too inefficient for that at current build. We looked as well at, with the amount of, this is really a loose look at market values of various areas of store value like gold, around $12 trillion of gold and store value. Overall, call it $15 trillion of store value kind of assets elsewhere. Just shifting 2 to 5% of that gets you to $100,000 of Bitcoin. I thought it was just a nice sort of thought exercise to see what's a valuation of Bitcoin. How might you get to $100,000? It's not purely fiction. There is some science to it as well around the store value, but it requires confidence. Finally, just to give you an overall picture of the environment in a bunch of numbers. I wouldn't be me if I didn't put a whole lot of numbers on a page somewhere. And on that final column tells you really what we've gone through, which is inflation is going, expected inflation, I should say, is going higher. Interest rates are going up. The U.S. equity markets are moving up. One thing that in the middle circle, green circle there, U.S. growth versus U.S. value. Last year was extraordinary for the growth style versus the value style. We see it more of a reversal this year on that, as the value style, in many ways, simplistically, is companies that have more near-term cash flows that aren't as impacted when interest rates rise by those near-term cash flows. Think energy companies and financial companies, materials companies. A lot of those things are confluent as well with, if you look on the left-hand side, number one, there were the underperforming sectors of last year, energy, financials, real estate investment trust related to, are people going to ever be going back to office spaces? The opportunities are a bit of a reversal of that, and we've started to see that this year. Financials and energy are the best performing sectors among all the S&P 500 this year. Stimulus sensitive, things where we are, not when I say we, I mean the global environment at this point, are spending extraordinary amounts of dollars putting out possibilities for so-called shovel-ready programs to build things which require copper wire, which require concrete and other areas. So stimulus-sensitive industries will benefit from this as we go through a reopening. Real estate investment trust, which are kind of partitioned between things like storage companies and companies that are more commercial office property or even mall properties. So reopening versus not so much reopening, there's a good possibility for those, especially because those are regulated dividend stream kind of companies. And as I talked about yield-seeking environment, they'll benefit from the yield-seeking behavior. Key points just to wrap all this up for you. We are outlook positive, and I've said I feel like I need to almost pressure all the downside risk, because there are always downside risk and we will see volatility through this cycle. But broadly, we see good opportunities. We see good business conditions. We see the spending as extraordinary for this year, and we need to recognize that. So we're outlook positive. Equity valuations are elevated, so they reflect a considerable bit of this outlook positive, but they can continue to go further if we realize our earnings stream that's expected. So I'm not looking for interest rates to move. I'm not looking for multiples to expand for higher expectations. I'm looking for us just to realize the earnings to get back to where we were pre-COVID. If we can do that, we can actually still see appreciation in the equity markets from where we are today. Fixed income, it still is good for investors to hold some fixed income in their portfolio for the insurance policy. That said, increasingly, we're going to be talking about alternative assets as a source of the so-called insurance policy. Now, fixed income, i.e. holding treasury bonds, so hopefully rates go down when the equity markets go down at the same time and your bond prices go up. It's one of the few places where, of course, you get paid to hold the insurance policy. You get an income. But we're going to be looking at alternative assets, whether does gold make sense? Does anti-correlated certain companies or sectors make sense? Increasingly, it will. Certainly, as you saw, the income differential between equity income streams and fixed income income streams, we'll look to that. Financials and energy we see as an attractive area, as we do real estate investment trust. The energy transformation and the technology transformation are I think you could almost say this is akin to, we've been to an industrial revolution. We've been through a tech bubble and a tech revolution in the 2000s. Right now, we are seeing something that is really strongly looking like this leap forward in technology and energy transformation. And it's going to be, there are going to be some hiccups and some fits and starts. But some of the transformation that we're seeing, and even the fact that I'm not at the Dallas Country Club walking with an old school microphone talking to you, but instead on Teams, is very different from what you expected to be in the next several years. So this has been a pull forward in technology. We see consumers adapting to that. The last bit of the client survey results, we saved it for last because we thought it was one of the most interesting, is what do you miss the most? Indoor restaurant dining, I'm the same as the majority here. That's one of the things that I miss the most. Leisure travel via airplane, certainly people miss the ability to get out, but they are not going to visit family gatherings. That was what was funny to me. 10%, or just about the lowest, are not missing going to see family, and 0% of the 80 participants in the survey miss going to shop at brick and mortar stores. So, while also kind of funny, it fits into the investment theme of transformation is here. Rather than go to the Gap brick and mortar store, which I kind of like doing, maybe I still go to the Starbucks next door, but rather than go to Gap, I'll just go shop at Gap online if they've got an online presence. So there were some interesting things that came out of this. Concerts, theater experiences, that's an industry that has been decimated by this. But that could easily see a very strong resurgence of interest, as we didn't just change thousands of years of human history and get away from a social dynamic and how we work together and how we go out and collaborate and spend. It's going to come back, and that's a key area for that. That's the end of the presentation. I appreciate it. We'll move into some questions, and certainly look forward to continued relationship in 2021.
Thank you so much, Adrian. My name is Leah Bennett. I'm the president of the Houston office of Westwood Wealth Management, and welcome again to everyone. I think Adrian summed it up well, that we are at this interesting crossroads. I mean, I was looking at just the Russell 3000 for the 12 months ended February 28th, and it's up over 30%. And I think no one probably would have guessed that if you were looking back at this as a period where we've gone through a pandemic, people have been shut in, and we've actually had the market performing well. And these interesting cross currents are really coming up. You have the emergence, this escalation in Bitcoin, as Adrian mentioned, value and growth, kind of this big violent switch that's happened in the market. And so we were looking through the questions, and obviously you guys have a lot of questions about what is going on. And so I'm going to start with the first one because I think it reflects, this question in particular reflects a lot of still skepticism about the market. And despite Adrian's made some great comments, and I think there's many reasons to be positive about the economy moving forward, but one of the often submitted questions that we saw is, what's the most likely indicator of an impending bear market in 2021?
And it's a great question. As an old school bond guy, the first thing I do in the morning usually is get in and look at my worrisome indicators of what the asymmetric risk are, what things could go down, what things could lead us down a bad path. I talked about interest rates. That's one of them. We are watching the 10-year interest rate, as it can be a little bit of a natural regulator on equity markets and risk returns, of confidence in the equity markets, which itself can be a vicious cycle. So watching the 10-year interest rate, ensuring that as it rises, so does our confidence in economic growth rise as well, will be a key element. And part of that is I talk about the 10-year yield minus the 2-year yield, otherwise known as the interest rate curve. After every single recession, that interest rate curve, the difference between those two yields, goes up to around 2.5% to 3%. Right now, we're about 1.3%. So after every single recession this happens, we just came out of an extraordinarily fast but deep recession. We still see the prospect for that happening. It will take time. So time is needed as well. That's something I'll watch for. You still have to keep an eye on China. China is still the largest contributor in the world to economic growth. They're not the largest economy, they're the largest contributor to the growth of the world economy because of their growth rate. And funnily enough, they have been the first nation to come through this and re-reach their old economic growth highs. Because of that, they may be also the first nation to pull the punch bowl a little bit, to stop spending, to potentially hike interest rates. And in doing so, that's something we need to watch if we see prospective growth rates in China come down, just as COVID hit our shores. So could the impact of growth from China. So that's something we'll watch that is still a potential downside for us. And just, as I said, one of the first things I check every day, stock of Tesla is one I truly believe it's one of those. It's not necessarily a bubble. I mean, it may be that when you next watch Blade Runner 2054, all those cars have Tesla written on the side. It's priced for extraordinary growth right now, extraordinary market share gains as well. Just doing that, that thought experiment of the market cap of Tesla versus the market cap of General Motors. Well, you don't really think about it until you realize the market cap of Tesla is up around $800 billion versus the market cap of General Motors running around $80 billion. That's extraordinary when you just put the pencil to paper on that one. So I watched the Tesla market cap, I watched the Tesla stock price. Doesn't mean that it can't be supported by longer term growth, but it does mean it's a representation of the exuberance in the environment for economic growth. But otherwise, inflation will be something that we'll keep an eye on. I tend to think truly that what we've gone through, the amount of stimulus and the debt spending, will actually keep us a little bit from heightened inflation, and the fact that the Fed is looking at with an eye to push down jobs and not worry so much. We'll have more time to evaluate. Doesn't mean it's not something to be concerned about if we see heightened inflation, but we'll have time to view that one before we can make a real big indicator on that. And then, one other thing we talked about, for you, Leah, we looked at these. One of the questions that we found interesting was the potential impact of the oncoming regulation for social media. And I know you had a lot of thoughts there, so I'll leave that one with you.
Yeah, I mean, I thought that was a really interesting question. Obviously, very topical, and I do think it's going to be really tough to regulate the different social media channels. I think that's going to be really challenging, and it's going to be interesting to look at kind of the industry from that light. I do think it brings up a lot of questions, though, about the valuations in tech. So ultimately, I think all these questions get back to what would you do from an investment perspective? And technology, especially talking about kind of the older tech, which is hard to believe we're calling it older tech, but Facebook and some of these other platforms, they've done very well, but valuations are quite high. And tech now represents, I believe it's 28 or 29% of the Russell 3000, which is a very high percentage. So I do think antitrust concerns about free speech, some of these others, the market never likes uncertainty. That will probably keep a lid on valuations for a while. And Adrian, you talked earlier about the switch that you had, that we're seeing going from growth into value. I do think some of these stocks and sectors that have done really well, such as tech, are just going to see money come out of them, and they're going to move into more economically sensitive. So I do think that uncertainty kind of creates a cap there. Another question that came up quite a bit is questions relating to their proposal to raise the minimum wage, and something else that is coming up quite a bit in the last few days. And what's that possible impact to inflation? I'm kind of curious what your thoughts are there.
I'd say it did come up quite a bit. So, people are focused on this, and let's say, number one, it's too early to really tell whether that's going to happen, what the policy is going to look like. And if it's anything, more than just a simple red herring from a Democratic Congress to get their budgetary ways and means through the Republican side of the House, it may be just that. But thinking about what would happen if we got that through, what would that impact look like for inflation? It's unclear, the impact. The longest study that I have seen on this is a study that is back to the 1970s that says how much does a wage increase impact immediate inflation. Do companies automatically go through and raise their prices because they have to pay their employees more? And it's really inconsequential. It doesn't say much. It says that a wage increase of 1% leads to, with a very low R squared, if you're a statistician, something like a 0.1% increase. It's low. It's not something that is telling us a whole lot yet. It'll be differing by industry. So when we look at the restaurant industry, where there's a high percentage of lower income workers, that's going to impact them harder. And I think that's going to be the important message for us is if we get closer to that and it looks like a potential, then it may make us take a dimmer view of some individual industries. As an economy, I don't think it'll be something that will slow us down, but it will potentially change the areas of growth.
Yeah, and I think that's where it's interesting as an active manager to be able to make those choices, because I do think, again, you talked a lot about the cost savings. A lot of expenses have come out of companies during this period of time, and then you'll probably see some additional expenses layered in some industries and not in others. So that's where individual stock selection starts making a difference. A related question around that is who will benefit as we lift 1.4 million people out of poverty, which was an interesting question and some element of that came up several times.
Sure. I'd be interested to speak with the exact individual because it's a specific number. So there's there's one thing you looked at, but it's unclear whether it's going to be 1.4 million lifted out of poverty with new policies or 5 million lifted out of poverty, or consequentially if raising the social net puts more people into poverty. And it's a fully politically charged question, no doubt. But it's still, no doubt it's still important for us to think about. If we pull people out of poverty, the economic impact of that is immediate consumption increase. It's positive in the near term for consumption. It's positive likely for the middle class, and likely it's if we're thinking about the policies of the current administration, without being too charged or whichever way, it likely comes at the expense of the wealthy, tax rates, et cetera. So that's where that expenditure would happen. But what's the reason for that is the more money you have, the less percentage of your income change is going to discretionary spending as you make more money. You save more, you buy more real estate, you put it in safe havens. Whereas if you're just at the marginal and you're making your rent and feeding your family and you get a bump, then you can buy discretionary toys. It's the percentage change is big. That's the near-term impact. So the near-term impact would be positive. The longer-term impact as to whether it's good for the economy is what the economists will argue about, and that's the charged question of which style of economics is going to work for our long-term growth and help us certainly repay our extraordinary debt load as well.
Yeah, I completely agree. I think it's going to be interesting, and I would be curious too. The question and the calculation with the 1.4, but there is a significant change there that definitely could impact economic growth without question, as well as quality of life. The other question that we had that came up quite a bit, which is not surprising, is around taxes, and you kind of mentioned taxes. So the Biden administration will move to rescind the Trump tax cuts. What will likely be the impact on the stock market with higher tax rates, including higher estate tax rates?
We actually, we looked at this prior to the election, thinking, investing for the potentials of outcomes. Looking at this prior to the election, we were looking a lot at the corporate tax rate as well. The corporate tax rate, of course, was taken down significantly and sits at around 21%, where the proposal from the Biden administration was to raise that effectively and quickly up to 28%. That would be about an 8% impact on earnings per share. So therein lies some significant impact on the equity markets. That said, it is offset, and that's what they were aiming to do. It's offset by other areas. One of those other areas is moving from immediate tariffs in the China trade war to diplomacy. We estimated that at around 8 to 9% immediate impact. The longer term is arguable, but the near term it's kind of a wash there. Obviously, tax increases are going to be a negative for the equity market, though. They're negative from the equity market from when you tax corporates at a higher rate, and when you tax the equity holders at a higher rate as well. It's not a positive. The Democrats will be looking for other ways to offset that. They'll be looking for maybe the offset of if that lifts people out of poverty, then you see the short-term boost of consumption spending as well.
Yeah, and the estate tax exemption, people are talking about it possibly going down to 3.5, which would be obviously a big change from the 11.7 per individual that exists today. And there's all sorts of ways that you can kind of look at gifting to family members, to charity. So those are also conversations that we're having with clients, and certainly on the top of everybody's mind. But you're definitely in a window where you can have those conversations and make moves right now. With that, I wanted to thank you, Adrian, for your time and for joining us on this call, as well as all of our clients. Thank you guys so much for joining us. I think it was a meaty conversation, and we appreciate, it was fun getting the survey results and being able to incorporate that into the presentation, as well as hearing from you all. We had lots of questions, and most of them kind of fell into those 4 themes, but thank you so much for your continued loyalty with the firm, and we hope everybody has a great evening and stay safe. Thank you so much.
Thank you.